They told you it was the good debt. They told you it was the only ticket to the American dream. Go to school, get the degree, get the job, and the white picket fence will follow. But look around you. Look at your bank account. Look at the grocery prices. Does that dream feel like reality, or does it feel like a hallucination? What if I told you that the degree hanging on your wall isn't a badge of honor, but a receipt for your own sale? What if the entire higher education system has been engineered not to educate you, but to trap you in a cycle of indentured servitude that makes the sharecroppers of the 19th century look like free men? We are not talking about a broken system. We are talking about a system that is working exactly as it was designed. A design that relies on you staying in debt until the day you die. The inflation you feel, the reason you cannot buy a house, it is not an accident. It is the mathematical requirement of a financial mechanism hidden so deep in Wall Street's shadow banking system that most economists are too afraid to touch it. Before we pull back the curtain on the greatest wealth transfer in history, I need to know who is standing with me. Drop a comment below and tell me where you are watching from. Are you in the US, the UK, Europe? Let us see how global this trap really is. And if you're ready for the unfiltered truth that the mainstream media is paid to ignore, smash that subscribe button right now. We are decoding the matrix, and you do not want to miss what comes next. To understand how you became a financial prisoner, we have to go back to a time when the system actually worked. Post-World War II, the GI Bill. The government realized that an educated workforce was a superpower. They invested in people. Tuition was negligible. A summer job flipping burgers could actually pay for a year of university. It sounds like a fairy tale today, does it not? But then the narrative shifted. In the 1970s and 80s, a new philosophy took over Washington and Wall Street. Education was no longer viewed as a public good. It was rebranded as a private investment. This was not just a semantic change. It was the opening of the floodgates for predatory finance. Let us look at the 17th century for a moment. If you were a poor laborer in Europe and wanted to come to America, you signed a contract, an indenture. You sold 5 to 7 years of your future labor in exchange for passage. You were owned. You could not quit. You worked where you were told. Your life belonged to the contract holder until the debt was paid. Sound familiar? Today, the passage is the college degree. The contract is the master promissory note. And the labor? That is the next 20 to 30 years of your life, working jobs you hate, to pay off interest that compounds faster than you can earn. The only difference is, in the 1600s, the contract had an end date. In 2024, thanks to negative amortization, your balance can actually grow while you make payments. Here is the modern parallel that should make your blood run cold. In the housing market, when you buy a house you cannot afford, the bank takes the house. It is a tangible asset. They foreclose. You lose the home, but you walk away. But you cannot return a degree. You cannot foreclose on your own brain. When the asset is you, the bank has to own you. In the feudal system, serfs were tied to the land. They worked the land, gave a portion of the harvest to the lord, and kept just enough to survive. Today, you are tied to the debt. You work the corporate job, give a massive portion of your harvest, your paycheck, to the servicers and the Department of Education, and keep just enough to pay rent. Sound familiar? They did not abolish serfdom. They just digitized it. They moved the chains from your ankles to your credit score. And just like the company towns of the Industrial Revolution, where the factory owner also owned the grocery store and the housing, ensuring the workers simply returned their wages back to the employer, the modern university system has become the company town. They hike tuition because they know the government will guarantee the loan. They build lazy rivers and luxury dorms, charging you premium rates, knowing you have access to unlimited credit. Sound familiar? It is a closed loop, a perfect circle of extraction. And just like the subprime mortgage crisis of 2008, where banks gave loans to people they knew could not pay them back, universities and the government are handing out six-figure loans to 18-year-olds for degrees that have zero market value. Why? Because they do not care if you succeed. They only care that you sign the paper. But who is they? And why are they so desperate for you to sign?
You might think the villain here is just greedy colleges, inflating tuition. Or maybe you think it is just irresponsible students. That is exactly what they want you to think. It keeps you fighting each other instead of looking up. The real villain isn't a person. It isn't a single university dean. It is a financial innovation. The turning point was a quiet decision to turn your debt into a tradable product. Just like they turned mortgages into bonds in The Big Short, they turned your student loans into something called SLABS, Student Loan Asset-Backed Securities. But for these securities to work, for Wall Street to bet billions on your tuition, they needed a guarantee. They needed to ensure that no matter how bad the economy got, no matter how worthless the degree became, the borrower could never escape. In 2005, a specific piece of legislation was passed, the Bankruptcy Abuse Prevention and Consumer Protection Act. It sounds boring, does it not? It sounds like bureaucratic noise. But hidden inside this massive bill was the lock on your cell door. This act made it effectively impossible to discharge private student loans in bankruptcy. Think about that. You can gamble away millions in a casino and declare bankruptcy. You can crash a business and declare bankruptcy. Donald Trump did it. 50 Cent did it. But if you tried to better yourself by learning to be a nurse or a teacher, you are chained to that debt until death. Who pushed for this? Who made sure that students were the only class of borrower in America stripped of consumer protections? The receipt is wilder than you think. It was not just Republicans. It was not just Democrats. It was the banking lobby, specifically companies like Sallie Mae and big commercial banks, who poured millions into the pockets of politicians to ensure that your future labor was legally theirs forever. But why? Why do they need you trapped? Because your debt is the fuel for a much larger, much more terrifying engine. You won't believe the name of the mechanism that keeps this entire house of cards from collapsing.
Welcome to the deep end. This is where we dissect the SLABS market, Student Loan Asset-Backed Securities. Here is how the sausage is made. When you take out a loan, you think it is a contract between you and the government, or you and a bank. Wrong.
That loan is a financial asset. Almost immediately, that debt is bundled together with thousands of other student loans. They take a loan from a medical student, a loan from an art history major, and a loan from a dropout, and they wrap them into a giant bundle. Then they slice that bundle into layers called tranches. They sell these slices to investors, pension funds, insurance companies, hedge funds. These investors buy these slices because they pay a steady stream of interest, your monthly payment. To an investor, you are not a human being. You are a yield. You are a cash cow. Now here is the sickening part. For SLABS to be valuable, they need certainty. They need to know the money will keep coming in. If you pay off your loan early, the investors actually lose potential profit. They encounter prepayment risk. They do not want you to pay it off. They want you to struggle. This brings us to the most parasitic number you will hear today. $1.7 trillion. That is the total outstanding student loan debt in the United States. To put that into perspective, that is larger than the GDP of Australia. It is larger than the total credit card debt of the entire nation. 92%. That is the percentage of these loans that are federal. But do not let that fool you. The servicing, the collecting of the money is handled by private companies who profit from your confusion. Let us look at the math of negative amortization. This is the trap. Let's say you borrow $50,000 at 7% interest. You graduate, you cannot find a high-paying job, so you go on an income-driven repayment plan. Your payment is set at $100 a month. But the interest accumulating on that loan is $300 a month. You pay the $100. You feel responsible. You did what you were told. But the remaining $200 of interest, it does not disappear. It gets added to the principal. Next month, you owe interest on the new higher amount. 5 years later, you have made every single payment, never missed a month, yet you now owe $65,000. You are paying for the privilege of owing more money. This is engineered collapse. It is a feature, not a bug. The system relies on capitalized interest. If everyone paid off their loans tomorrow, the SLABS market would crash. Pension funds would take a hit. The illusion of wealth on Wall Street would evaporate. Let us look at another number, 169%. That is how much the cost of college tuition has increased since 1980, adjusted for inflation. Wages,
They have stagnated. Why did the price go up? Because of the Bennett hypothesis. When the government guarantees loans, universities know you have an unlimited wallet. If the government says, we will lend any student $20,000, the university says, great, tuition is now $20,000. If the limit goes up to $50,000, tuition goes to $50,000. It is a wealth transfer from the future labor of the young to the bloated administrations of academia and the bondholders on Wall Street. This is moral hazard on a galactic scale. The universities have zero risk. They get the money up front. If you drop out, they keep the money. If you cannot find a job, they keep the money. If you die, in some cases, your parents are still on the hook. It is a form of parasitic finance that feeds on hope. They sell you the dream of social mobility, but the financing of that dream guarantees social immobility. The SLABS market creates a perverse incentive. The servicers, companies like Navient or Nelnet, have been caught repeatedly steering borrowers away from loan forgiveness programs and into forbearance. Why? Because forbearance allows interest to capitalize. It makes the loan bigger. It extends the life of the asset. They are farming you. You are the crop, and the harvest season never ends. Consider the shadow banking system. These SLABS are used as collateral in other financial transactions. Banks trade them, leverage them, and borrow against them. Your inability to pay your rent is literally providing liquidity to the global banking casino. If the student loan bubble pops, if millions of people simply stop paying, it is not just the Department of Education that suffers. The shockwave hits the derivatives market. It hits the repo market. It hits the collateral chains that hold up the modern economy. That is why they are terrified of cancellation. It is not about fairness to the plumber who did not go to college. It is about the solvency of the asset class that underpins the ledger.
We are living on borrowed time. The numbers simply do not work. You cannot have an entire generation, millennials and Gen Z, starting their economic lives with a mortgage-sized debt and no house. You cannot extract this much wealth from the working class without consequences. The birth rate is plummeting. Why? Because people cannot afford children. Home ownership is delaying. Why? Because the debt-to-income ratio is destroyed. Small business creation is down. Why? Because you cannot take a risk when Sally Mae demands her cut every 30 days. The system is eating its own future to feed its present greed. This is the definition of a dying empire. And do not think this is just an American problem. The UK is following suit. Canada is watching. The model of financialized education is a virus that spreads because it is profitable for the elites, even as it destroys the host. We are in a state of mass denial. We pretend that the next bailout, the next income-driven plan, or the next pause will fix it. But you cannot fix a Ponzi scheme by adding more participants. You can only delay the collapse. The next crisis will not look like 2008. It will not be empty houses. It will be empty lives. A generation of highly educated serfs, owning nothing, renting everything, and paying interest on their own existence. So I have to ask you a final question. Are we wiser now, or are we just walking the same path as the indentured servants of the past, just wearing better suits? If this video opened your eyes, you know what to do. The algorithm hates this kind of content. It scares the advertisers. Share this video with a student, a parent, or anyone who thinks the system is broken but does not know why. Subscribe to the channel. We are building a community of people who refuse to be collateral. Until next time, question everything, follow the money, and break the chain.